So now let's look at short exercise 1-10. Okay, short exercise 1-10 is on page 36 of your text. And in this exercise, we're going to look at how transactions affect our accounting equation. So we've talked about the accounting equation by now. So we're going to look at how different transactions affect the accounting equation. And when we say a transaction is anything that occurs that's going to change the position of either party involved. And it's going to be something that's happened between one or two or more people. So make sure you know what a transaction is. So in this exercise, we've got extreme inflatables, and they earn service revenue by providing party planning services and inflatable playscapes. Extreme Inflatables is owned and operated by Emma Gonzalez, and during the past month, she had the following transactions. So let's take a look at A. It says Emma contributed $8,000 to the business in exchange for capital. Okay, so anytime a business is started, an owner has to put in money. So in exchange for putting in money, they're going to get this account called capital. This is kind of like their investment in the company, okay, in the business. And when we were talking about the accounting equation, assets equals liability plus equity, assets are things of value that are going to help the company generate revenue over time. And then liabilities are debts or things that are owed by the company. Equity is what's left over. After we take all the assets and if we paid all the debts off with our assets, that's what's left over. And that's kind of the value of the owner's investment in the company. So that's what kind of essentially the capital is. Okay, so let's look at, she contributed $8,000. So that means she gave in cash. Okay, so cash is going to go up, and cash is an asset account. It's something of value. So that's one thing. We have an increase in an asset, which is our cash. And then this is going to be an equity. Okay, so it's increasing equity. Anytime we increase capital or give capital out, we're increasing it. So that capital account is an equity account. So it's increasing our equity. All right, so let's look at B. It says we purchased equipment for $2,000 on account. All right, so we purchased equipment for $2,000 on account. Anytime you see on account, this is going to be something that we're going to pay later. So if it's anything we're going to have to pay, think of like a credit card or a loan. So this is going to be a liability. If it's something that we're letting a customer get something on credit or purchase something on account, that's something that's going to be paid to us in the future. So it's going to be what we call a receivable, which is an asset because it's a debt that's owed to us. All right, so we're getting equipment here. That's something that we're gaining. And anytime we have equipment, that is an asset. Right, so we have an increase in an asset of $2,000 and also a liability. We're not paying for it now, we're going to pay for it later. So this amount that we're going to owe is a liability. So we have an increase in an asset and an increase in a liability. So our asset is the equipment, and the increase in our liability is what we're going to call accounts payable. Okay, that's just a general liability account that we'll put in there that is something that we owe. We'll get more specific for other liabilities, but right now we're just going to use accounts payable. Okay. All right. Then C says we paid $300 for office supplies. All right. So we paid something. Anytime we paid something and it doesn't say on account, that means cash is leaving the company. All right. We got business, conducting business, and we got cash going out. So cash is going to decrease. So cash is an asset. So we're decreasing our assets and we're getting something in exchange for the cash. Office supplies. Okay. So office supplies are something that we're going to use up. That's going to help us generate income. So that's an asset. So we have an increase in our assets. Of office equipment, supplies, and a decrease in our asset of cash. All right, then we've got D, says earned and received $1,500 cash for service revenue. Okay, so cash is going up, so we're increasing that cash, so we're increasing our asset. And then in exchange, we provided service, okay? For the cash, we provided a service. So anytime you see for service or for a product, that's going to be revenue. So we've got revenue here, and it's going to be a, let's see, increase in equity. All right, so revenue and expenses are equity accounts. And the revenue is going to increase our equity, and the expenses decrease equity. All right. Now, E says we pay $200 for wages to employees. So again, we're paying something, all right, and they're wages to employees. Now, wages to employees are an expense item. Anything that we incur that's a cost of doing business to help us generate revenue is going to be an expense. So this is an increase in expense. Let's see. Well, first let's do our decrease in asset. We have an increase in our expenses because we're incurring that cost, but it decreases equity. Okay. All right, now let's look at F. It says Emma withdrew $500 cash. All right. So withdrawing means she's taking it out. So she's taking out cash. So we're going to have a decrease in asset, okay, of our cash. And anytime a person takes out withdrawals or takes out cash of the business and they're an owner, it's going to reduce their capital account, all right? But we're going to keep up with that reduction in a separate account called withdrawals. So withdrawals decrease our equity. So we're going to put Gonzalez withdrawals. All right. Now let's look at G. It says earn $2,000 for services provided, and the customer has not yet paid. So in G, that we do have an asset here. We provided a service and we were supposed to get paid, but haven't. Anytime a customer owes us for services we've already completed, we're going to have that asset called accounts receivable. So we're going to have an increase in our assets and have accounts receivable. And then we're also, in this one, we're going to have an increase in equity because we provided that service. Okay, so we're going to have service revenue, and that increases our equity. Okay. All right, the next one says we paid $800 for rent. So again, we're paying something out. We're going to have a decrease in our asset account for cash. We're going to decrease cash, and we're paying a bill here. We're paying for rent. Rent is an expense, so we're going to have a decrease in equity of rent expense. Okay. All right. Now the last one says we received a bill for $150 for the monthly utilities. The bill has not yet been paid. So utilities are an expense, all right? Something we've incurred costs for in the course of conducting business to generate income. So we're going to have a reduction in our equity because we have an expense, but it says we haven't paid it yet. So when we haven't paid something yet, that is an increase in our liabilities. All right, so we're going to increase the liability, and this would be accounts payable again. And then we're going to decrease equity. I'm using that utility expense. And when we get further along in the chapters, that accounts payable would actually be maybe a utility payable. We would keep all the payables in their own account. But for now, let's just keep all of the amounts that we owe in accounts payable. Okay. So again, if you have any questions on this exercise, please post your questions to the Chapter 1 questions for discussion board. Okay.